Welcome. Today we're diving into economic value added, or EVA, a powerful tool used to decide which projects add real value to a company. In project management, selecting the right project is critical. EVA helps us measure whether a project is truly profitable, that is, whether it generates returns above its cost of capital. EVA is essentially the profit left over after a company pays for the money it has invested. In other words, it tells us if a project is creating wealth or destroying it. Let's break down the formula. NOPAT stands for Net Operating Profit After Taxes, which is the profit from operations after paying taxes. Invested capital is the total money put into the project. Think of it as the funds you need to get started. WACC, or Weighted Average Cost of Capital, is the average rate of return that investors expect for providing capital. Subtracting the cost of capital from the operational profit gives us the EVA. When choosing between projects, EVA is a clear indicator. If a project has a positive EVA, it means the project is generating more profit than it costs to finance it. In other words, it creates value. On the other hand, a negative EVA signals that the project isn't covering its capital cost and is likely to destroy value. This makes EVA an excellent tool for filtering out poor investment options. Let's look at a real-world inspired example. Consider a company, let's call it Coke Co., evaluating a new project. Imagine this project is expected to generate a NOPAT of $400,000 per year. The project requires an investment of $3 million and the company's WACC is 6.4%. Here's the math. Calculate the finance charge. Finance charge equals invested capital times. WACC equals $3 million times 6.4% equals $192,000. Now calculate EVA. EVA equals NOPAT minus finance. Charge equals $400,000 minus $192,000 equals $208,000. Since the EVA is positive, Coke Co would see this project as value-adding, making it a good candidate for investment. Many leading companies use EVA as part of their project selection process. For example, Coca-Cola and GE have both used EVA to decide which projects or business units deserve further investment. They found that when management focuses on projects with high EVA, it aligns decision-making with creating shareholder value. To recap, EVA tells us if a project is generating returns above the cost of capital. The formula is simple. EVA equals NOPAT minus invested capital times WACC. Projects with a positive EVA create value and are typically chosen, while those with a negative EVA are avoided. Using EVA helps companies make informed, financially sound decisions that drive long-term growth.